Hi everyone, this is Chris at 3 Point Capital, and today we're going to show you how utilizing data analytics and machine learning can help you locate high probability trade setups in the futures markets and also help you to price and manage that risk. Now before we get started, I just want to take you through the risk disclaimer, which you can see on our website in the member area, risk disclaimer. To sum it up, trading futures and futures options is a risky business and you own that risk. Now that can easily be mitigated utilizing options and futures options, but it's up to you to execute that plan. Okay, so today we want to take a look at crude oil. Here we're looking at a weekly chart, and we have the 3 Point Capital adaptive moving average lines, which we use for trend indicators. We have our 23 weekly, which you can see bearing down here on price, and we have our 4-week adaptive channel, which crude has been riding on the way up. Now, a couple things that we want to point out here. First of all, we can see in the fourth quarter last year, we had the big crash along with equities once the Fed came out convincingly that they were going to be raising rates and tightening liquidity. The market absolutely collapsed. And then we can see here at the end of December, we have a nice doji hammer type candle, which basically set the bottom. And this was right at the time that the PPT came out and pretty much indicated that they were going to help support risk assets. And they also started really putting pressure on the Fed to cease this tightening operation. And we all know what's happened since then. They've done that, and it's kind of been a risk-on rally since. So we've now been rallying since the end of December. And there's two things that I want to point out here. The first is we use adaptive channel lines for trend indicators at 3 Point Capital. And we like to look at a 23 period and a 4 period. So the 23 weekly we can see is really bearing down on price here now. And as price has kind of come back towards this downsloping channel line, we can see a stalling here. The other point is our short-term indicator, which is a 4-week adaptive channel. Price has been riding this channel higher, and we now see that the 4 channel is actually entered into the 23 channel band. Okay, so it's definitely been bullish price actions, and bulls have been paid off for those who have gotten in to catch this bounce back rally. But the question is really what do we have here? And now I want to zero in on the daily. So really the first thing we want to point out is that all of the upside in this crude rally really occurred from December 24th through February 1st, right? So that's when we pretty much went from 42.5 to almost 55.5. And really over the past 5 weeks, crude has just kind of been bouncing around in the sideways range, trying to digest these gains. And we are seeing some signs of visible technical weakness. We see our oscillator not confirming these new highs. We see instead of riding this 4-day channel higher, we're now starting to move into a sideways posture, and price has just kind of settled into sitting right on top of the 23-day channel. So effectively what we're seeing is a stalling after a massive rally. Now the other thing that we want to point out, which is coincidentally or not, outside of our adaptive channel lines on the weekly and the daily, we are seeing further resistance here at the 50% retrace level of the fib line. So from this entire drawdown in the fourth quarter, we've now rallied up right into about the midway point of that, and price is now stalling out. Okay, so as you can see, the technical picture is one of a crash, a rally, and now a stall. Now the next thing we want to take a look at is the commitment of traders report to see what's been going on with the commercial participants. Just to make a quick note, the CFTC is still not caught up to date as of yet. We only have data through February 19th, but it's interesting nonetheless. So when we look at the commitment of traders reports, we want to look at two things. We want to look at participant positioning as well as activity. And importantly, we want to be able to measure that against prior activity and positioning over the past 18 months and 5 years. So we have a proprietary scoring model, and we rank positioning and activity on a scale of 0 through 100. Anything that's 90 or above, you'll see highlighted green. What that means is that it's bullish in terms of activity for that participant, not necessarily for price. And if it's 10 or below, it's bearish for that participant. So this report, the first half is showing you the commercials, and the second half is showing you the funds, okay, and what they're doing. Now, when we look at crude oil, we can see is that on an 18th month basis, the net commercial position score of being short 322,000 contracts scores a very bullish 90. Okay, so commercials are always short crude and crude products, but this is an extremely low short position for them, and on an 18th-month basis, it scores a 90. Now, funds, on the other hand, they're long 314,000 contracts, and this is actually a very low position for them. So they're coming in at an 18th-month score of 8%. Okay, so pretty bearish leaning by the funds. Now, common wisdom is that commercial is always correct and funds are always wrong, but is that necessarily true? Well, we can take a look. So what I want to do here is, in our data analytics platform, which is titled Alchemist, we're able to measure price distribution given specific technical setups. So we want to go over to our commitment of traders reports, and we want to look at funds, and we want to see every instance where net funds have had a commercial score, a net position score of 10 or lower. Okay. And what we can see here is, going back to 2008, we've seen 51 instances where this has happened. Okay. Now, the first thing that we'll note is the average line. So 20 days forward, after a 10 or low score has been registered, on average, we've seen crude advanced $4.29, but it's declined $7.78. Okay, so average activity is almost 2-to-1 in bear's favor here. Now, of course, averages can be skewed by large outliers. So what we have here is a percentile table telling you the probability of price advancing or declining a certain amount. So now when we go 20 days forward and we want to look at what happens 70% of the time, which is our yellow highlighted lines, what we can see is 70% of the time crude will advance $1.35, and 70% of the time crude will decline $2.58. So this is now showing you that when funds are extremely bearish crude, 70% of the time prices will decline by $2.60 over the next 20 days. Okay. Now the 50th percentile is even greater decline, $6 versus $3 increase. So everywhere we're looking here, it's indicating that we have 2-to-1 odds in favor of bears given this condition. Now, just to further point out, if we look at the probability table, which is just showing us the likelihood of crude oil moves without any filter. Okay, so this is just from any close. So if we go back to 2008, we can see that the average is much closer to 1-to-1. Okay, and the 70th percentile, it is 1-to-1. It's 220 versus 210 down. Okay, so very big difference given this score. Okay. Okay, so now to go back and to summarize the current setup that we have, we want to take a look at the weekly again. Okay, we have price advancing into fierce resistance, which is the downsloping 23 adaptive channel, right? It's also bumping into resistance of its 4-week channel high, which is also coinciding with a zone of the 50% retracement of the drop. And to add to the bearish picture, we see that funds hold a very bearish 8% score on their 18th month net position. Okay, so multiple indicators and probabilities showing us here that it's time to place a short bet. Now, one of the last things we want to look at really quickly is just seasonality. We want to make sure that we're not stepping into a time period that's seasonally very bullish for crude. So in looking at the month of March, going back to 2000, we can really see that it's 50-50 odds. Okay, so now in April, it's significantly higher with 63% winners versus losers. So we want to take advantage of what we believe will be a pending drop in crude over the next 20 to 30 days. So what we're going to do is just bring over our option page here. Now, as we discussed right in the beginning, yes, futures and options are and can be risky. However, if you trade futures and then collar them with option positions, you'll actually be fixing and locking in your max loss. Okay, so Currently, there's only 9 days left in trading of the April contract for crude. So we're going to want to go out to the 41-day period and trade April crude. And currently, April crude oil is trading at 56.70. Now, as we discussed, there's a pretty fierce resistance right around 58. So what we want to do is we want to buy the 58 call for $1.43. And as we'll be going short, we want to cover our short position to help finance the cost of this protection. Okay, so we're going to sell a 52 put. So this is what's referred to as a risk reversal, and there's just a couple things we want to point out here. The first is that the net cost of this protection is bid 79 by asking 83. So mid, you're basically going to pay 81 or 82 cents for this hedge. Now, what's important to note is the delta here, right? So the delta is 59, and basically what that means is that you can expect your option to offset 60% of the underlying move in crude. Okay, so if we were to go short right here at 56.70, now if our thesis is correct, we should not see a close above 58, right? We want crude to stay below 58, roll over, and then break down and allow us to cash in. But really what we want to do is be able to measure what our max downside would be. So if we're wrong and crude closes over 58, rather than losing $1.30, you're going to lose approximately 40 cents of $1.30. Okay, so roughly that would be around $600. Now, if we're correct and crude starts moving down towards 54, 53, and all the way to 52, your downside is open until 52. So really then what you have is you have downside from 56.70 to 52, which is $4.70, minus the cost of your protection of 80 cents or so. So that's maximum $4 upside. And as we said, if we see a close above 58, we're going to close out of this entire position with an expected loss of $600. If our position is correct, we will be able to profit anywhere between $2,000 and $4,000, and that's basically setting you up with a risk reward of anywhere from 3-to-1 to 5-to-1. So just on a closing note, we just can't stress how important it is to stick with your trading plan, stick with your stops. If you were to put this trade on and you're wrong, you only lose $600. And really what that'll allow you to do is to reevaluate and potentially get back in at a much higher price with much greater upside for your short bet. So thanks for watching this video, and we'll see you next time.